Good morning, good afternoon, happy Friday. Yes, y'all. It's your girl, Shirley Nichols, right here at Mortgage Money with Shirley podcast here at the Morris Media Studios, live and direct here in Los Angeles. Let's get it, y'all. It is Friday. It is a great Friday. I don't know if it's because it's the first Friday of the month. I don't know, but it is a beautiful, wonderful day. Great time to be alive. Great time to be standing and doing all this fabulous stuff, right? And trying to make your life go a little bit smoother. Yes. So I'm your girl. Like I said, it's Mortgage Money with Shirley. It's my podcast. We are on episode 28 today. Episode 28 is You Got Equity? Heloc it. We're going to get into that, y'all, in a few more seconds here, but it is, you got equity, you have equity, you've built all this wonderful value in your property. Use it before you lose it. Okay, we're going to talk about that. But again, please tune in live. Bring your friends, coworkers, neighbors, family, friends, enemies, whoever you got. Just bring them to the podcast and maybe they'll learn a little something. Or maybe you'll learn a little something. Or maybe you could gain some information that you can pass on to someone else if it's not for you right now. And if it's not for you right now, that's okay. Like I said, take what you learned from today's podcast and pass it along so somebody can get some money and start building their investment portfolio and start doing some marvelous things, okay? So you can find me on Spotify, YouTube, my YouTube channel, guys. My YouTube channel is my first and last name, Shirley Nichols. And again, the podcast is Mortgage Money with Shirley. So we always upload these videos, podcasts. We always upload them to YouTube. So you'll get them right after the show or tune in live now. Again, I am here in the Morris Media Studios, but you can also leave your questions, comments, and concerns on my Facebook page right here, my Facebook personal page, Shirley Nichols, or my business page, Mortgage Money with Shirley. So again, there's all kinds of ways you can contact me. It's only a 30-minute segment. Sometimes I go a little longer, but no, it's going to be 30 minutes because we are behind today. But never mind that. Just know that you can contact me. And after this episode, after this podcast, we will have my phone number I will give to you so you can contact me with any comments, questions, or concerns. If you don't want to leave them in the comment section now, that's okay. You can definitely give me a call. All right, so let's talk about it. Episode 28, y'all. You got equity? Heloc it. So now here recently, guys, we've talked about it in so many previous podcasts. We've said it, and I'll say it again. Interest rates have gone up. That's just it. Short and little, small and easy. Interest rates have gone up. About a week and a half or so ago, the Federal Reserve Bank, we call them the feds, they went in and they increased interest rates. That's what they do, right? The whole talk is, we got to hedge off recession. We got to hedge it off and make sure we don't go into a recession. We got to hedge off inflation. We have to keep making this U.S. dollar stronger so that it doesn't weaken the economy. So when they get this in their heads, there's no turning back, right? It's straightforward. Here we go with increasing interest rates. And that's what has happened, right? About a week and a half ago, the Fed said, raise them, they raised them. That's it. Short and simple, but interest rates have gone up yet again. Now, we're hoping that this is the last of the hike for this year. Is it? I don't know, because what they're trying to do is, for the last 2 years, right? I mean, it seemed like the economy was moving. And if you don't know this by now, I've said this several times in my previous podcasts. It's the housing industry, the housing market that really jump spirals and jump starts this economy in the right direction most of the time. And they get their cues and signals typically from the housing market and other things, of course, the war in Ukraine and oil prices and all that kind of goes into the economy and what's happening and why inflation may be on the rise and all that kind of stuff. It's a lot of things that do combine what makes this economy go round and round, right? But a lot of it stems from the housing market, and economists figure if they slow the housing market down, then that would help us to not have this inflation problem. So now what are we talking about? Like I said, for the last 2 years, everything was spinning so fast in the housing market because rates were down. We had these sellers who were listing their prices and actually getting more than what they were listing for, $25,000, $50,000 over asking price. All that was going on for about a year and a half, 2 years. This thing was spiraling out of control. And I don't think it was out of control because, I'm a consumer, I'm a homeowner, I'm a home buyer. So, for me, business was great, for the last 2 years, year and a half, 2 years. Business was booming, great. Fantastic. But what happened is there became a shortage of inventory. Housing markets started, like I said, spiraling, out into the universe. And because of that, we could not maintain the cycle that we were going down, right? Interest rate could not stay at the bottom or under the 3% rate, in the 2s and 2.5 and 2.25. Interest rates could not stay where they were. Okay, the market couldn't sustain it because everyone started buying houses, paying over the asking price. Everything was moving. And much sooner than later, the inventory for the housing market started to shrink, right? And then all of a sudden you saw construction costs with lumber and other materials start increasing their prices, right? So inventory, material and construction costs going up, interest rates at the bottom. We had things, it just went crazy. So the only way that economists and the Federal Reserve Bank figured they could slow things down and get it back on track where it's a normality versus something that was not really normal, the only way they figured they could do that is to increase interest rates, okay? Increase interest rates. So then sellers, maybe not so much of a seller's market now. You stop asking for the $20 and the $50 and the $75,000 over asking price of your house. You stop wanting those kinds of things. And now sellers are just like, hey, why don't you just buy it at asking, right? So that was one way to try to slow this economy down, and the weakening of the dollar slow that so that our dollar doesn't become devalued, so to slow everything down, let's increase these interest rates. So now there's not really a shortage of inventory in the housing market anymore, right? Sellers aren't really asking for, give me $25,000 more than what I'm listing it for. Give me $30,000 more than what I'm listing it for, and that truly happened. Hey, not my issue because that means we were gaining money, right? So, it was a wonderful, wonderful time to be a homeowner in this last year and a half, 2 years. You could buy more property at cheaper rates. You could reinvest and refinance. So let's talk about the refinance. Let's talk about got equity, Heloc it. Episode 28, guys. What am I talking about? Well, as you noticed around the globe, interest rates, yes, went up, but so did, if you notice, the value of people's properties. Yes. As a homeowner, I watched the value of my property. It didn't double. Now, don't get me wrong. I sure would have liked it to double. It didn't double, but it wasn't too far from the mark, from when I bought it. Great investment. Great investment. And now it's worth oodles and oodles of more. So, like I said, anytime that you can afford to purchase a property, buy it, because it's a great time when the cycle does this and you're in at the best time ever, So year and a half, 2 years went by and equity started doing this, right? The value of the properties around the globe started doing this. Values shot up, right? So now the good news is, the greatest news, I should say, is that the values did do this the last year and a half, 2 years. They shot up and the values sustained. I haven't seen in recent times, I'm talking from yesterday to a week ago, I haven't seen when we're sending out appraisers to either refinance someone's property or help them buy a property, I haven't seen the values plummet. I haven't seen that. And that's a great thing. I'm super excited because back when the market crashed in 2008, that's the first thing you saw was values. Doop. Values plummeted faster than, values dropped significantly in 2008 when the market crashed. So the naysayers were saying, oh, the market's going to crash in 22. The market's going to crash in 22. Oh, right? But it didn't crash and the values did not sink. So all this equity that you've amassed, all this equity that has appreciated in your property, guess what? More than likely, it's still there, right? We have sustained values. I don't really see a lot of increase in values like I did last year. But what I do see is the values pretty much on target where they probably should be. That's what I'm seeing, right? They've all sustained that equity increase. They've all kept their values instead of dropping. And that's a great thing. So what I'm saying is use the equity before you lose it. Because although I'm saying this right now in the month of August 2022, I don't know what it's going to look like in August 2023, right? But that is why, most importantly, sometimes it's best to use what you got, right? The equity that you've amassed in your property over the last year and a half or 2 years. If there are things, again, I said this my last podcast, if you're refinancing on purpose, right? If there's a purpose behind your refinance, if there's a purpose behind using this equity, then use it for the right purpose. So let's talk about it. The Heloc. Home Equity Line of Credit, HELOC, Heloc, Home Equity Line of Credit. Did you hear that last 3 words? Line of credit. That's what it is. It's like a credit card, except for more advantages. What'd you say, Shirley? More advantages, more benefits, more things to help you with your portfolio. What do I mean by that? It's money that you're taking out of your property, yes, to reinvest it, hopefully in another property. Or maybe you've got college kid tuition that you need to pay. Maybe you're not friends with Sally Mae. But nonetheless, when you have this home equity, this equity in your home, in your property, when you have this equity, why not set up a line of credit? Why not? So here's a couple of things. First, the home equity line of credit. A lot of clients have often asked me about, well, how does it work, Shirley? What do you do? All right. So the home equity line of credit, first thing first, it is a second mortgage. Okay. Please don't mistake or misunderstand that anytime someone offers you monies on the property, short of you selling the property, it's going to be a lien. It's going to be a mortgage. Okay. So the home equity line of credit is a second mortgage. It is a lien on the property. They will record that new dollar amount at your county recorder's office with the piece of paper that says deed of trust. Okay. So that's what it is in short. Now, is that such a bad thing? Oh, no, not at all. With doing this home equity credit line, one, like I said, being that it's a second mortgage attached to the property, it's tax deductible. What'd you say, Shirley? That interest rate is tax deductible. Yes, you can write this interest off on your taxes, on your tax returns, on your personal tax returns when you do them come April of next year, right? If you do a home equity credit line right now, and you need a tax break, another tax deduction, another tax write-off on your taxes, well, then a home equity credit line is perfect for you. The interest on that home equity credit line is tax deductible. You can write that off next April, okay? If you do it in this year. If you do any type of equity line of credit or anything on your home in the year 2022, you can write that off in 2023 when you do your personal tax returns, okay? Do understand. Greatest thing ever, because guess what? On this line of credit attached to your property is more advantageous than going to the bank and getting just a signature line of credit, a credit card line of credit, because you know why? Those signature lines of credits, they're not tax deductible. And their interest rates typically are, topping the high 15, 16, 17, 18, 20 percenters, right? With the home equity credit line that's attached to your property and gives you a tax break, typical interest rates are about 5-6%. I mean, a lot cheaper than going to get that line of credit or that credit card that's at, upwards of 15% to 20%, 30% even I've seen, okay? And it's not tax deductible. So now, again, the questions I get, is it a mortgage? Is it a lien? Yes. Can I take the whole line of credit with me to the bank and deposit it? Yes. Because again, it is a line of credit, right? Unlike a credit card, kind of a line of credit per se, because you just use it. With the credit card, you kind of use it as you go, right? You swipe it if you're at the store or whatever. That's what the credit card does. But with the line of credit, you can take all of that cash, put it in your bank, and then you can start making payments on it, and it replenishes itself. You can start using it again. So yes, the line of credit, you can take the whole credit line, put it in your bank account, make the payments, and it starts replenishing itself. That is the line of credit. It revolves around like a line of credit. Now, there are typically two options to that. There's the line of credit where you can, draw down all of it and then start paying it back and it replenishes itself. Or there's another lump sum installment home equity. Okay, that one is not a credit line. It's just a home equity loan. It's just a loan. It's an installment where you take the whole thing and there's nothing to draw against. Even when you pay it back, the money does not replenish itself. It is a home equity loan. You've taken the whole lump sum and said, I don't want that revolving business. I'm good. And the reason why that some people will take the whole lump sum and call it a loan and not replenish it is because most of the time, those are your fixed rate loans, okay? Most of those home equity loans that you draw down the whole thing and you don't have the ability to use it again, that's typically a fixed interest rate, okay? And so that's why some people choose to have that, or they, don't want the ability to reuse it because they don't think they're, disciplined enough not to, keep using it like a credit card. But on the revolving home equity line of credit versus the loan, the line of credit typically will come with an adjustable interest rate. And the rates, just so you guys know, I'm 50-50. I don't care if you do the fixed rate or the adjustable rate. I'm kind of 50-50 in this market because rates are already, like I said, they're tipping at 5 and 6% anyway on the home equity. And, if the rate adjusts down, you'll get the benefit of the lower rate. If it adjusts up, you do get the higher rate. But I mean, like I said, rates are pretty, on the higher end anyway. So I'm kind of 50-50. You make the decision on how you choose to do your financing. But the reason why I'm bringing up this Heloc, this home equity line of credit, is because you've amassed this equity in your property and the values are sustaining. They're not dropping. So that means you've got this equity. Use it before you lose it. Because like I said, next year, I don't know what my crystal ball is saying. I don't know. The values may drop a little bit. They might even go higher. I don't know, but you got it. Use it before you lose it, right? Now, a lot of the times I get questions like this, but I want to sell my house in the next 6 months, I think. A lot of homeowners start thinking, oh, the market's really good, but then it's going to tank. I might as well take my money and run. But I don't know, because where am I going to live? Where am I going to find another house? Home equity, right? This is when it's it's the greatest time to use a home equity line of credit. If you're that homeowner who's thinking, oh, I really should sell my property now, take the money and run, but then I don't know because little Johnny and Sally are in college and I really need to save for their college tuition. I really don't need to try to go spend money and buy another house. Home equity credit line. Because here's the rationale behind it. Let's just say your house is worth, I don't know, $700,000. And you owe $300,000. Okay? So you owe $300,000, it's worth $700,000. So you've got this $400,000 equity, right? My point is this. If you sold it in the month of August, you're going to get your $700,000. Okay? They're going to give you a $700,000 sales price, sold it, going to subtract the $300,000 that you owe. You're going to pay these commissions to your agents, and then what's left is yours. Okay? Sell it. Fine. Go ahead. If that's what you want to do in the month of August. But let's just say in the month of August, you're thinking, I don't know. Maybe I'll wait till December. So right now you've got the $400,000 worth of equity. Guess what? You don't have to pay any real estate agents or any commissions. The money, this $400,000, most of it, some of it, however you want to, qualify and apply for it, could be yours now. Versus waiting until December when you're going to subtract out from that equity, you're going to subtract out the agent's fees and commissions, right? You're going to subtract that out. And then what's left after the mortgage is paid off, what's left is yours, right? Oh, mind you, don't forget, you will probably be hit over the head with some capital taxes, some capital gains, right? So newsflash, you will have to pay capital gains taxes on the property that you sell if it's an investment property. So they'll take that out. So again, what I'm saying is before you get into the idea and the theory, oh, I can just sell it and I'll sell it 6 months from now and get my money. But if you've got little Johnny and Sally going to college in the fall and they need money now, or if there's an investment deal that, there's a fixer-upper at 123 Main Street that I can buy right now, but I need this cash, now is the time. Use your equity before you lose your equity, before you miss out on that great investment that you wanted to get. But, oh no, the money is a little tight right now because the gasoline prices suck it all up. But okay, but what I'm saying is, again, if you don't want to wait to sell the property and get your money now. Either way, whether you wait and sell it and get your money, or you get your money right now, you're still getting your money, right? And I think that's what a lot of my clients, some of the clients, the older clients don't quite understand. If you sell your property in December, you're going to get XYZ dollars. Or if you did a home equity credit line right now, you're going to get XYZ dollars. The bottom line is it's your money. It's your equity, right? I don't care when you get it. Well, Shirley, if I sold my property in 6 months, and I've got this equity line I've got to pay off, I've just lost some of my proceeds. How? How did you lose your proceeds? Remember, if there's $400,000 worth of equity and you take $100,000 now for the home equity credit line, when you go to sell it, guess what? They're going to pay off this $100,000. You're still going to be left with the $300,000. So how'd you lose it? You just took an advance, right? And if that's the way you want to look at it, you just took an advancement on your money, on your equity. That's rightfully yours, right? You just took an advance, if that's the way you want to look at it, but it's still your money. When you sold the property, you were going to get $400,000. Well, you just got $100,000 of that early, okay? You got $100,000 of that $400,000 that you had. You got $100,000 of that early. That's all you did. You get it? So what I'm saying to you is this. There are so many ways to take advantage of this housing market right now, even when interest rates are, have increased. Even though the Federal Reserve Bank came in and Chairman Jerome Powell said, hey, we're going to increase these rates right now, about a week and a half ago. Even though he said all of that, and that's what happened, in this time, in this market, you can still take advantage of the housing market, utilizing what you got to go get something else. These home equity credit lines, guys, I'm telling you, they are popular. They are so much of what a lot of clients need because that's a way to increase your portfolio. Taking what you got, home equity credit line, and go purchasing that next investment, that next house if you want it. Or you're reinvesting in your children's education. I keep bringing up this college thing because school's getting ready to start. So again, home equity lines of credit, tax deductible, and that's why I said you got equity, HELOC it. Use a HELOC to your advantage. And guess what? What, Charlie? As you make money from, I don't know, you work some overtime, you get a new job, promotion, you buy that investment property, fix it up and sell it for more. As you're making income, you can always pay down or pay off your home equity line of credit. And guess what? The money is yours again and again. No matter what I'm trying to get folks to see, your property is the biggest asset you'll probably ever have in your lifetime. But use this asset as your reinvesting tool, right? Instead of going out getting a bunch of credit cards, right? Credit cards are not tax deductible, folks, and it's typically not your money. It's the bank's money, and you're going to pay the bank back. But here you have an asset, a property that is your money. This equity is your money. Okay, if you're going to use anyone's money, I get it. People are real big on OPP, other people's money, or OPM, other people's money. People are real big on that, right? But I say, that's good, that's great. But if you've got an asset that's an equity account that you can draw down from, it's your money, reinvest in yourself, use your money. It's tax deductible, why not? That's it, So I talk about that all the time in my previous podcast. We talk about HELOCs and refinancing because, like I said, I am an advocate of refinancing. But I also real quick want to talk to you guys about the reverse mortgage. Okay, the reverse mortgage. I've said this before in previous podcasts as well, and I'm going to remind you because a lot of the times I think people kind of forget about the reverse mortgage. It is not as popular, it takes a special person with a special need to do the reverse mortgage or to want the reverse mortgage. But I tell you, the reason why I want to bring this up to you now, a little piece of information here. The lenders, most lenders out there, have just installed a new reverse mortgage option. And what is that option? It is a jumbo size reverse mortgage. Before, I want to say earlier this year, like around January, February, there were talks about this jumbo size reverse mortgage. It really didn't come into fruition, or it didn't come to pass, or they didn't start to execute or offer the clients this jumbo size program until about mid-May. So it's fairly new, but there is a jumbo reverse mortgage option out there. This is great. This is huge because prior to this option being there, there was a cap, right? There was a cap on what you would really qualify for as a reverse mortgage client. It used to be you'd have to be 62 and a half or somewhere in that age range. But now you can be 59 and a half, somewhere in there, right? So they've lowered the age requirement down to 59 and a half, I think, or it might be right at 59. They've lowered the age requirement and they've increased the maximum amount of monies that they will consider. Meaning it used to be prior to this option that the value didn't matter if your house appraised for $2 million, $3 million, didn't matter because there was a cutoff benchmark that they would use for reverse mortgages. Okay. And I think that cutoff, I can't remember, but I think it was like about $825,000. So it didn't matter if the house was worth $1 million or $2 million. None of that really mattered because they would cut it off at about 8.25, something like that. But now there is a higher benchmark for the jumbo reverse mortgage, which means more people are qualifying for it and they're getting larger loan amounts. Huge. So I bring up that reverse mortgage because we are closing reverse mortgages now in a jumbo loan capacity, and that's great. So if you have a client or if you have someone that you know that needs to do a reverse mortgage, just remind them the age requirement has dropped and the loan amounts have increased. They've got the jumbo product for the reverse mortgage, and it's phenomenal. It's great. So again, if there's any questions or comments, I said I would give you my phone number to give me a call, and that's 818-720-7575. And if you have any questions that you need me to answer, I will definitely respond to you either on Facebook, Instagram, any of the social media platforms. Like I said, subscribe to my YouTube channel at Shirley Nichols Mortgage Money with Shirley Nichols. Subscribe and tune in. I'm on this podcast twice a month on Fridays, twice a month, and typically about 9:30 Pacific Standard Time here in California, about 9:30 in the morning. So if you miss it, you can always replay it and let me know what you think. But again, it's your girl, Shirley Nichols, Mortgage Money with Shirley. And I hope you all have a blessed weekend and take care till next time. Bye-bye.